Hello, hello, and happy Wealth Wednesday. My name is Lisa Lickert, and I am your instructor for today as we focus on college funding. Now, this can be a very conversational event. This is all about you. So as questions come up, what we wanted you to do is drop them in the chat. Stay muted because background noise is really difficult for those that are joining us to be able to hear. And then we're also recording this for YouTube. So we want to make sure those that are watching later on don't have that background noise. But we want to hear from you. We want questions to surface as we go through today. So use your chat. Andrea is going to be checking that chat, surfacing questions as they arise. I'll do my best to answer those. We'll also have some time at the very end. Sound good? All right. Now, with that said, let's get the party started. College funding. This is a hot topic. Certainly this time of the year, but all year round. And before we get started, I want to better understand where everybody is coming from. So describe your knowledge about college funding in this way. Tell me with the poll, tell me A, very familiar, somewhat familiar, aware, but not really sure how everything works, or not familiar at all. So Andrea, pop up the poll there for us today, and let's see what everybody's perspective is. All right, so answer those questions with the poll that has popped up, and we'll give it a couple more minutes. When you see me looking to the side, please know I just have a second screen trying to manage everything today. So forgive me for looking to the side, but let's see here. Let's see, it looks like we have most of the results in. So the majority of those are joining us today are actually a little bit over half of joining us today are somewhat familiar with college funding. So you guys provided us your survey results when you registered. We know a little bit more about your questions. Now we kind of know about your familiarity. So we'll make sure we take care of you today as we present the topics and go along. All right, so thank you for that, Andrea. And here we go. Come on, screen, you got you. All right. So the cost of higher education, this is not factoring in inflation for future years. This is just putting a stake in the ground, 23-24 surveys, and saying, what does education cost? These are semester costs. So if you're saying, oh, wow, that's cheap compared to what I'm paying or what I am saving for or what I think college is going to cost, it's because it's on a semester basis. My son went to college and he went to a public school. He was out of state, but right on the border of Ohio and Kentucky. So he was eligible for a scholarship. He was able to get those in-state rates. So those are semester. And if you think about it, that adds up pretty fast, doesn't it? So we're all in front of these huge bills to invest in education. So let's talk a little bit about what I call buckets of funding opportunities. So the first one is the one that most people know the most about, and that is financial aid. So financial aid comes in a few shapes and sizes. It's going to be your scholarships, it's going to be your grants, it's going to be your loans. And what you do in order to assess your eligibility is you complete what's called a FAFSA. And so that's something that helps you understand those opportunities. Now there's all kinds of savings plans. They come in all shapes and sizes. That's the next bucket. But the most commonly known are 529 plans or ESAs. And that's that we're going to talk about that bucket today. Some have tax advantages, some do not. And then there's the student loans. Wah, wah. So this is the part that is probably the most daunting just because of the debt and the process and the overwhelm and the stress. We're definitely going to do a dive into private and federal student loans today. So let's get started with financial aid. Again, scholarships. Scholarships are a big part of financial aid. They come from sources like the school themselves. You can get scholarships because of your academics. You can get scholarships because of sports or athletics. You can also get scholarships through private organizations. And so there's many options with scholarships. Those do not need to be paid back. The second category are grants. Grants work the same way, where you're not paying those back, but those are usually based on need, not merit. And so there's federal Pell Grants and a few other programs that are very specific to either the state or the funding source that you can become eligible for. So we always say, just fill out the FAFSA. So make sure you're filling out the FAFSA first, no matter what your situation is, no matter what your planning process has been up to that point, you're going to do just that, because that really gives you the foundation and helps you build that perspective of what avenue you need to pursue. So the FAFSA, it's going to qualify you, and it's going to be able to really help you follow all of those guidelines. Timelines are a really big deal. Just from our experience, that we blew through some timelines that we didn't even know existed. We thought we did all of our research. It just gets a little bit complicated. So make sure you're aware of those timelines. Make sure you're having the conversations you need to have to confirm your understanding, and just be very careful about that whole entire process. Now, scholarships, as I mentioned, they do not have to be repaid. They're usually awarded on academics or athletics. Those are the ones that we're most familiar with. Universities provide them, but also personal or private organizations do as well. And they usually are used to supplement. There's full scholarships, full rides to school for sure. But not traditionally speaking, scholarships are going to supplement other college funding sources. Now, there are 7 types of scholarships. So this is kind of cool because there's a diversity of opportunities for everyone. If you're not an athlete, there's another category. If your academics aren't competitive, then there's another category. So the good news is there are a lot of scholarship opportunities, no matter who you are and what your background is. Now, biggest questions we get all the time: how do you find this? Where do you look? Where do you go? Did I see it? Do I know of everything that's out there and available to me? So what you want to do is you just really want to start with your college or your institution. Just really understand what the opportunities are there. I mentioned to you in our situation for my son, he received a scholarship that covered his out-of-state tuition expenses. So it was right there on the state border. So that was available to him. We did not know that was available until we were talking with the college and understanding opportunities. So there's also TRIO counselors and high school counselors that you can tap into and you can ask questions for, and they can help guide you to opportunities that might be a custom fit to you. Now there's state grant agencies, and so you want to tap into those as well. There's a California, what is it called? Cal Grant, yeah, Cal Grant, the Hope Scholarship in Georgia. There's all these different types of state grants, and so you want to make sure you're visiting the state education department. Visit the state in which you reside and the state you wish to go to school, because there could be multiple opportunities there for you to uncover. Now, there's also foundations, there's places like religious organizations and civic groups. And so what I always tell people, use AI. Everybody needs to be using AI in their life in some way, shape, or form. These are a lot of categories, right? And there's some websites that we'll jump into here in the next slide. But don't get overwhelmed. Just use incredible prompts in AI. Use your favorite AI tool, whether that's ChatGPT or something else, and say, this is who I am in the state I live, in the state I'm going to. This is what I'm looking for. What is available to me? You can also say, outline a plan for me to pay for college using grants and scholarships available to me. And so now the responses aren't going to be perfect. You have to get those prompts prompts kind of finalized, but these categories can really help you kind of finalize those prompts and really refine that AI plan. Okay, so professional associations, moving right along, is another thing that is an opportunity. So if you're going into a business program, sometimes there's business incubators that offer grants or scholarships to students that are going into that field. U.S. Department of Labor has a website where you can tap into that, and that's another resource for you to take a look at. So the common kind of online tools are going to be your FastWeb. It's going to be your scholarship.com and your CapEx. So those are the common tools that people use. Obviously, I just shared with you AI. There's probably going to plug in some other tools that kind of pop up through that plan. But that helps you because you're going to filter through your qualifications, and it's going to help you identify what you have available to you. This is not a one and done type of a thing. This should be something that you're doing every single semester. So ask counselors, mentors, community leaders, ask people that are in school. Maybe you've got some school mentors that may have been kind of navigating through this in recent years. Use them in their experiences as well. And you'll always hear me say, check those deadlines, because it's extremely painful when you miss a deadline and you either have to delay a semester or you have to figure out how to come up with that tuition payment. Okay, savings plans. So this is where I get really excited, because no matter where you're at, there's typically some opportunities for you, but this is for those folks that have some benefits of time. There's some savings plans and opportunities that really get the job done. First, we're going to talk just a little bit about those options. So there are education savings accounts, there are custodial accounts, 529 plans, and there are even insurance products that help you fund school. So we're going to go through those, and we're going to go through advantages and disadvantages of each, so you have the information you need to make an informed decision. So let's cover education savings accounts. These are tax advantage accounts. So that is a huge benefit in itself. And it is intended to help families save for college. Now, actually, it's more than college. It's full education, because you can tap into these funds that are tax advantaged as soon as kindergarten. So you can pay for schooling fees from kindergarten to 12. You can also do it for private school, so it's not just college. These savings accounts, like I said, they're going to be tax-free. Withdrawals are going to be for educational qualified expenses. It does have a broader span of use. So some of the things like a 529 does not have as broad of a use. So that is an advantage. Oh, do we have a question? Okay. I thought I heard somebody, I thought I heard Andrea chime in. Sorry about that. So then the disadvantages, well, the low contribution amounts. So you can only contribute to these education savings accounts a couple $1,000s a year. And then depending on who is saving and what their income is, you might have some limits, some caps to what you can save. So it's not a large amount of savings that's tax deferred, but something is better than nothing. And so then you have to use, the beneficiary has to use it before their 30th birthday. So typically, if you're in a traditional education pathway, that is not a problem. But if you have an untraditional pathway, let's say you're working while you're going to school or you're getting a higher education degree, then that could be something of a challenge. Okay, so those are education savings accounts. We're going to talk about custodial accounts. So these are accounts that adults basically have for their children, grandparents, parents. And the way the accounts work is you are able to, as the adult or the grandparent, the aunt, uncle, you're able to have this account and manage this account. And then the assets are transferred and owned then by the child or the student. So the advantage, you have flexibility. So you can use the funds for the beneficiary. There's a little bit more flexibility on how the beneficiary uses the funds. There's no contribution limits. So you don't have the caps that a lot of the plans are going to have placed on you. And you can, you may avoid tax consequences. So you really have to look at the custodial account to see exactly how the tax structure is within the account itself, but you may have some of those tax benefits. Now, the disadvantages is this is an asset. So this is going to impact financial aid eligibility because it is an asset on hand, and you have this asset as the student that you can contribute to tuition or expenses. There's really no tax deduction for funding. There might be some tax consequences or tax benefits associated with the account, depending on how it's structured, like I mentioned, and advantages. But there's no like built-in tax deduction or tax advantage. It's not going to reduce your taxes on any type of gains in that investment. And it can't be changed. It can't be changed. It cannot provide, tax benefits to the donor. All right. So you can see each of these have some pros and cons. Now we're going to go into the 529. I think the 529 is the most commonly known and used plan out there. And part of that is because employers for a period of time were offering it as a benefit plan for their employees to contribute to. So they were offering a payroll deduction. The employee was contributing on their own, and they were then sending those funds into the 529s. They made it administratively easy. And so a lot of people started to become very aware of 529 plans. My husband and I, when our son was a toddler, that's how we learned of a 529 plan, and that's how we got started. And so that's why they're most commonly known. This is going to offer you some tax advantages for college. Some of the positives there is that tax-free growth, and withdrawals are qualified expenses. So as long as you're using the withdrawals for the beneficiary's education, then you have tax-free growth. It's low maintenance, and you can contribute higher amounts. So you don't really have an active account where you have to be fully managing. There is flexible investments, which is good. Investment options are flexible, and they're favorable aid eligibility treatments. So it's not going to disrupt too much of your financial eligibility. State tax deductions as well. So you can kind of see that that's a healthy advantage list. And so these are really strong plans to consider. Some things to also know when you're considering that 529. You must use it for education. You cannot use it for anything else. And like us, we have an only. It was hard to get him here, and the good Lord blessed us with them, but we knew we weren't going to have other children. And so we were just keeping our fingers crossed and praying that he chose to go on to college. And so that's something you have to understand, because if you do that savings and then no one is using it for college, then you are going to have the tax implications of the full amount and growth. So there are fees and certain ownership rules to the 529. I just kind of referenced some of those in my example. You can't self-direct the investments. While the investment lineup is flexible, you can't self-direct, so you really don't have that control. Where I say it wasn't going to be affecting your eligibility for financial aid, it actually does, but it doesn't affect the eligibility treatment. So excuse me, I had to back that up just a little bit. And then there's limited state tax benefits. So something I'm going to, qualified expenses include. So the qualified expenses for education is going to be that room and board. It's going to be those tuition fees. It's going to be technology expenses and fees. You can use it for K through 12. This is actually, I think, an amendment to 529. So that's really cool, especially if you're going to private or religious schools as well. So again, if you aren't going on to college, or maybe there's some early rumblings there and those types of things, then you still can benefit from that tax-free growth. All right, so here we are with our next poll. Are we ready? So have you ever considered tax advantage or non-traditional strategies? So this is relating to saving for college or funding college expenses. This is non-traditional strategies or tax advantage strategies. Give me a yes if it is you're currently exploring, which is A. B, heard of it, but not sure how they work exactly. And C, no, this is new to me. All right, we got the poll running here. And let's see, a couple more people. Here we go. All right. 60% of those that have joined us today have heard of it or heard of them, but they're not really sure how they work. So this is kind of leading, because what do you think we're going to talk about next? We're going to talk about how they work. All right, come back here. So we are going to focus today on life insurance, if you believe that. So people don't think of life insurance at all when they're talking about college funding, college savings, access to college, access to funds, tax-free or tax advantage to pay for college expenses. And it's really a disservice because these plans have been around for many, many years. I wish somebody told me about it when I was starting my 529 for my son. I'll share with you that little bit of a personal story here in a little bit. And they are very strong vehicles when you have the benefit of time to help you in providing those, covering those costs in college. So how they work is a little bit different. You're not doing a full withdrawal, but you're doing a loan using the withdrawal feature on a cash accumulation life insurance policy. And you can access that cash for tax-free. And then the death benefit can complete a college savings plan if the wage earner dies prematurely. That heaven forbid that happen, but that does happen. So people don't necessarily protect themselves from losing the funder of our college experience. Like I said, there is potential for tax-free growth and tax-free distributions for sure. And it's under control of the policy owner, and control does matter. So this is a little bit of a multiple part strategy. It's multi-part strategy. So we usually wouldn't talk about this as in reference to college funding, but because there's multiple features within a permanent life insurance policy, it's going to solve for things across the board. It's not a pure college funding play. And one of that is an accelerated benefits rider. So this acts like if, let's say, disability benefits. So for those that may not have had access to disability benefits, what happens when you get in an accident? How do you replace your income? What happens if you have a chronic illness? Those types of things, this is baked into life insurance policy, and it helps protect regarding those life occurrences. Won't get into it more deeply than that, but it's like a little, I always call them bells and whistles, something that is a part of it. So it's a value add or an added feature. Going into the advantages and the disadvantages of considering life insurance for your savings and funding plan for college. So the advantages is that you have a death benefit or a cash value that can help you with that college plan. There's tax benefits to it. It's not going to affect your federal funding. So their calculations do not factor in a life insurance policy. You have those accelerated benefits that I just shared with you. We call them living benefits, and that covers things that happen in your world that you simply cannot afford without that type of coverage. And then the cash value is where the sweetness comes in. So what happens is the cash is invested into an index. Common indexes are S&P 500, NASDAQ. And so that the cash part of the policy accumulates over time. You access that policy. And then if your tuition goals are no longer needed, that you can shift. You can shift into maybe buying a house later on in life or other expenses that life throws at you. Here's the disadvantage. You need to understand the policy. I've said a lot of words here, so there are some complexities to it because it's an investment vehicle, not just a life insurance policy. So you want to make sure you understand the investment allocations. You want to make sure you understand fees, those types of things, and working with a professional to make that decision if it's the right option for you. And if the loans are not repaid, that's a choice. You don't have to repay the loans on the policy, but it does diminish that death benefit and the cash value overall, which could be more than fine, but you need to be aware of that. It does require time to build. You cannot invest in a life insurance policy today and expect large amounts of cash to be there next month. So you do need the benefit of growth on your side in order to tap into that policy. So you also might need to have additional funding to reach that desired cash level for the time of college. So what the thing to think about is your timeline to college, what your goals are, and then just making sure that you do have that benefit of time. All right, so we laid it out on one single page. If you're like me, I would be getting my cell phone out and taking a picture of the screen. We will be blogging about this as well as, like I said, recording this session, and it'll be available for you on YouTube and on LinkedIn. But for today, it's really good to kind of lay this out. Again, we talked about several buckets, and we talked about several options in each of those buckets. So we've laid out the life insurance option, the 529, the custodial accounts we talked about, as well as the education savings accounts. Has everybody had a chance to take a picture? I'm going to hold it for 1, 2, 3. All right, here we go. Now, student loans. Before we tackle student loans, let's talk about the cost of borrowing for a degree. So something to think about when you go into student loans is debt. Your debt to income ratio, when you are managing debt to income, you want your debt to income ratio to be 25% or lower. Now, that is really hard to achieve when you're in your career and you're early in life. And so many lenders and creditors will allow someone to be at 36%. So you take your income and you take your debt, and that's how you calculate your debt to income ratio. So when you're thinking about that after college, that is something to always, or when you are thinking about college, that is something to always have in your back pocket, okay? So if you look at student loan debt, the averages of $37,000, you're looking at approximate payment of $500. So if you consider your car loan, that is going to be relative, most likely, to your car loan. Your starting salary, and these are averages based on the College and Employers National Association, okay? That's $59,000 a year. I think a lot of students will want or expect something much higher than that, but this is the reality of starting out compensation after college. So the long-term impact is that people with student loans, 60%, and that's actually a lower statistic than what I have recently been seeing, but 60% for purposes of today of people that borrow for student loans put a pause on life because you cannot afford what your normal goals would typically be once you secure employment, and that is buy a house or do travel in some cases, those types of things. You simply cannot do that. So that's something just to always stay focused on, understanding what that position is after school, and then how all of those numbers are going to work out for you from a debt to income ratio. Okay. All right, so student loans, you want to choose your best option when you are going for student loans. You have private, you have federal. They're going to be taking a closer look at your financial situation. They're going to be taking a look at credit, risk tolerance, and your personal preferences. You're also going to have a lot of conversations about things like cosigners and parents' income and those types of things. So be prepared for that. You typically have to pay back student loans. There are a few exceptions to that, like in the military and things like that, but you typically have to pay back student loans. So on the federal side, the Department of Education is who manages the managing body of student loans. The federal side, there's no credit check required. Most students can apply without a cosigner, so that's always good. And a lot of times there's no payments for 6 months after graduation. Sometimes that can extend a little bit longer. And you are subjected to amount limits. So there's you can qualify up to certain amounts on federal loans. Okay, amount limits. So undergrad, you're probably going to be limited between the $5,500 and the $12,500. You get a graduate status, then you're going to be limited to $20,500. And so these are unsubsidized loans, and this is based on an academic year. So types of federal student loans, you get a direct subsidized. This is for undergrads. It is going to be covered, like interest is going to be covered while you're still in school. You're getting a direct unsubsidized, I think I'm saying that the right way, for all students regardless of the need. And this is interest that accumulates immediately. Direct plus, graduate students and parents, credit check is required. And then the direct consolidation, it combines multiple student loans into one simplified management, because as you can imagine, as you are applying for additional loans, consolidation is extremely important when you're talking about managing and repaying your loans. Some private student loans, usually it's going to need a cosigner. There are many institutions that do private student loans. There are organizations out there specifically established for private student loans. They're going to be a little bit more expensive than federal loans because everybody's in the business to make money. And then a little bit less flexible in repaying options than federal loans are going to be, just because of the risk tolerance of those private student loans. So if you don't qualify for federal student loans, you can go to the private student loan section or option, and you're just going to need to have really good credit scores. You're probably going to need a cosigner if your credit score is below that 650, and that actually is a low number than what we've heard of recently. They come from banks and credit unions. There's online lenders. And like I said, there's very specific organizations that do only this. And every single lender with a private student loan is going to set their own criteria. So if you think you know what that criteria is for one institution, it could certainly be different for another. Okay, repayment plans. So we have a standard repayment plan. We have income driven, pay as you earn, graduated, and extended. So it really just depends on your eligibility and your personal situation, which payment options you are eligible for. So standard repayment, this is standard. This is the most known out there. You're going to have, it's about a 10-year. This is going to, sorry. I lost my track. Okay. This is going to last 10 years and is the best one to stick with if you want to pay less in interest over time. So I had a little brain hiccup there for you. Sorry about that, guys. So this is really what people, when you go into student loans, you really have the hope that you're going to have a 10-year payoff. This is going to help you long-term because of those interest rates for sure. But again, understanding your debt to income ratio at the very beginning, understanding what options that you are eligible for really are going to give you that pathway for repayment options. Income driven, this is based on a percentage of your income. It can last up to repayment of 25 years. They say that when the term is over, the remainder of the debt is forgiven. This is not necessarily a free pass that you're not going to have to pay the total amount of loan. Just remember, you have to factor in interest. And when you have a percentage of income, as your income grows, those could be some pretty significant income-driven repayment plans. And then pay as you earn, again, the 10% of the income, and the payments are recalculated annually based on your income. I was flipping those two around. Okay, you're going to graduate repayments on graduation. Those are going to, that lowers your monthly payments, but it does increase the amount you pay over every 2 years for a total of 10 years. So if you are doing a graduated repayment, you really have to crunch the numbers. You're going to extend your payment. There's another extended repayment plan that starts low payment amounts and then increases over time. This one is favored just because of finding the job, getting settled in the job, ramping up for income. Sometimes this is a really good fit if eligible. Okay, so repayment options. immediate, interest only, partial, or full deferment, again, based on your eligibility and situation. So immediate is going to require that steady stream of income or financial support during your studies. So immediate repayment tends to happen when you have a job as you are attending school. This is a really good option if you can manage your time well and really be able to have that job while you're going to school, and then you're paying off as you go. This is going to be the least expensive way for you to have loans and manage your loan repayment. Your interest only repayment is, as it accrues, you're going to be paying off that interest and you're still in school. So the cool part about it, while you're not paying down your principal, you're really managing your overall loan amount because you're paying those interest payments. Of course, you do need to have employment enough to be able to afford those interest payments. There's partial interest payments, and then there's full deferments. So that's the full deferment is going to delay all the payments, including your interest. This sounds really, really, really good when you're a student because you want to focus on school. And so we're going to delay those payments. We're going to get that perfect job right out of graduation, and you're going to start the repayment. So the thought there is just being very careful because of the job market and because of the amount of debt that does accumulate through school. So paying off student loans, you just like any other loan, you want to do your best to make additional payments if you can and ensure those additional payments are going to the principal. You're going to start early with a part-time job. Hopefully, while you're in college, you're going to be able to start making those payments on interest, if nothing else. And then you're going to establish a college payment refund or repayment fund, And there's a couple ways to do that. High yield savings accounts can accomplish that. And there's some other things that can, where you are able to increase your money by the growth rate. And then at that point in time, you're then able to pay off your college loans after you are done with school. So it's really kind of the cost of money. And you're going to stick to a budget, right? You're going to stick to a budget. You're going to take advantage of all those tax deductions, those tax advantage accounts. And you're going to consider refinancing your loan or consolidating your loan. Don't default. When you default, your entire loan comes due. There's a lot of misconceptions regarding what's happening with loans and government assistance as it relates to that. You're going to lose your eligibility for future benefits. When you default on your college student loans, it will take you years to be able to reverse that impact on your credit and your ability to basically live life because you're going to have such a negative impact so early on in your career. There actually may be some legal action as well when you default, so be careful, be aware. And then some schools may just not allow you to attend. All right, forgiveness programs. There are some forgiveness programs out here. There's public service loans, teacher loans, nurse loans, and then the first one that is a FOR, not an FOUR. They're for plans that calculate payments based on monthly income. So be aware of what government offers within those forgiveness programs. Now, that was a lot of words. That was a lot of information, and we definitely did not do deep dives into everything because we don't have that time together today. So what we did is we put together a checklist. For step 1, obviously, you're going to define your goals. We've already said that. You want to make sure you understand your estimates. You want to make sure that you're factoring in at least a 3 to 5% for inflation. And we invite you to meet with a team member that asked you to be a part of today or invited you to be a part of today, because a lot of things that I said were very, very specific to your strategies, your needs. There was a lot of tax advantage strategies. There were a lot of pitfalls, advantages, and disadvantages, and the alternatives with the tax life insurance. I'm going to tell you my story before I go into the next one, but My son, we only had one, like I shared with you, and we started our 529. Fast forward, he went to a state school here locally, and our 529 that we funded since he was a toddler, because when we did our look back, we realized we really didn't have control over those investments. We did really well. We had the tax advantages, but we ran out of money in his senior year. So saved since he was a toddler, did all of the things, checked the boxes, and we weren't able to fund his senior year. So being now in financial services and being exposed to all of the financial vehicles, one we talked about today with life insurance, I reran the numbers. And if I had an index universal life policy versus a 529 for my son, we would have been able to fund his senior year. So I never even thought about life insurance. I certainly didn't think about the cash accumulation and the tax-free withdrawals. Never. Nobody ever said anything to me. Like I said, we were exposed to the 529 at the time. We thought we were doing what we were supposed to do, check the boxes. So it's a very powerful tool. And I wish somebody invited me to have this conversation at the time that I was taking a look at the 529 to see which one was going to be the better fit for us. So make sure you spend that time doing just that. So step 2, you're going to have your savings target. You're going to calculate your estimates based on living expenses. You can do it on a monthly, you can do it on an annually basis. And you want to make sure that you know exactly what your pacing of savings should be based on your expenses. You're going to decide if you're going to fund a portion, a half, or an all, and what those projected costs are. Make sure you have those buckets. And then you're going to choose the savings vehicle. So clearly, not one size fits all. We recommend a diversification of funding sources, and we recommend getting started as early as possible. You're going to evaluate your tax advantages, your contribution limits, and your control, and the control that you have on those investments. I just gave you a pretty great example of why control on investments matters. You're going to apply for all of those for that free money first, right? We talked about the FAFSA. You're going to do it every single year. You're going to make sure that you're searching for those grants and those scholarships before considering loans. You're going to use AI. You're going to use everybody that you can talk to that has had the past experience. You're going to do your research. And you're going to visit this annually. You want to make sure that you're adjusting your plan annually. Things change all the time. Needs change all the time, and availability of money changes all the time. So review your savings progress, review what school costs are updating, not just for inflation, but also cost increases at the school level too. And then you have to rebalance your investments. So when you meet with a team member to do your initial conversation and exploration on your opportunities, you will be meeting with that team member every single year to review all of that work that you do together. And then you're going to adjust your contributions as income or goals or as your goals change, because life happens, goals change, plans change, majors change. People go on to higher education, didn't think that they were going to, those kinds of things. All right. Last poll of the day. So after today, what is your next step? Tell me in the poll. Tell me if you're going to use that checklist and make your plan, make it your own plan, or revise your current plan. That's number A. Tell me if you're going to meet with somebody and just ensure that you have all the right strategies lined up. Let me know if you're going to research topics you discussed today next, or if you're not going to take any action at this time, although it was good information. So A, B, C, or D, the poll has opened up. And we have 4 people. You're going to research the topics you discussed today. All right. I love it. I love it. Information is power. We've got a person on the first one that they're going to use the checklist and do their own plan. That's good stuff. That's good stuff. Get back here. So just know that you're not on the road on your own. Whoever invited you here today, they have the tools, the abilities, and the skills to hold your hand. No obligations, in a complimentary discovery session to figure out exactly where you are and help you map out where you need to go. So if anything, you want to make sure that we've left you with the concept of preparing yourself, preparing your child. That's one of the best life lessons, is the financial wisdom. It lasts much longer than any degree. So with that, I don't see any more questions in the chat. Drop them in real quick if you have them. All right, so we have no more questions in the chat. So with that, we leave you today, and we look forward to talking to you and seeing you in the future. Take care.